All right, as promised, we are starting a new series called Investment Strategies. And the purpose and goal of this is to make sure we identify various strategies that you can implement and use for your investment plan. And the reason why we want to make sure you understand the various strategies is that everything isn't for everyone. And we have to identify what works best for us. Believe it or not, everyone has an investing personality, and you have to identify what works for you. What is your personality? What are you comfortable with? Some people are comfortable with lots of risk, whereas others don't want any risk. They don't want to have a heart attack watching numbers all day long. So the goal is to show you the different styles and put it in a way that makes sense and that is simplified, which is the whole purpose of StreamlineiG. We want to make things more streamlined, easier to understand, and simple to use. So let's go ahead and get started first with our disclaimer, and that this is for educational purposes. This is not financial advice. We are not responsible for your gains or your losses should you choose to invest in anything. Once again, our goal is to educate you. So we want to make sure that is our disclaimer is put out there to start. So what I came up with is a strategy of understanding the employment of money and looking at it from the perspective of I have all these different investments. So these investments are considered my businesses. And when you have multiple streams of income, I call it being in mogul mode. And the only way you can be in mogul mode, which means a person who has multiple businesses, multiple entrepreneurship opportunities that they're managing and running, you have to own your 24. You only have 24 hours in the day. There's only so much work that you as an individual can do. So how can you produce more income without having any more hours? Well, you're going to have to employ something else to work for you. And in this case, you're taking your money and investing your money, or rather, I like to call it employing your money to go out and do something for you. The more employees you have, the more hours you're actually producing for yourself within a day without you yourself doing any more work in the sense of a job. I'll put it that way. So, how can you do that without adding more stress to yourself? So if you employ your money has to have a goal. It's just like when you're hiring an employee, you don't hire an employee just to be hiring an employee. You already have in mind what you want them to do and what you expect them to do. And then you go find the employee that meets the need that you're trying to accomplish. The same thing should be happening with your money. We have to switch from working for money to letting money work for us. And that's a different mindset. So if we start thinking of our investments as jobs that we're employing, we're sending out our money as employees to go work for us, to produce something and bring something back in return. So if you look at it from that perspective, what roles could you put your money in? And then you can start identifying which strategies you need. Your strategy is the role that you're employing your money to do. So I came up with these 5 things. One, foundation builders. Every every investment platform or every investment, every investor, every well-known investor has something that we like to call our foundation builders. Foundation builders are things that you're putting money into that creates passive income that you can just walk away and not have to look at. Even if you're out grinding and you're working 5 jobs or 3 jobs, or you have multiple investments that are producing income, taking some of that and putting it in a foundation builder where it's continuing to create passive income without you having to do anything. You don't have to monitor them. And although there's always some risk in investing, these are pretty safe. Then there's conservatives. We're going to talk about those. Conservatives are conservative investments that don't make a lot of money. They're slow producers, but they're consistent and they're stable. You have your growers. Growers are more risky, but those are things that grow quickly. They produce quick money. However, their losses, they can lose just as much as they gain. And consider those like growth stocks. And then there's the ones that most people see that make them want to get into investing in the first place. And that's the casino players. Casino players are things that produce large amounts of money. We see posts on Instagram and Facebook all the time where people are posting where they made $72,000 on a stock in 1 hour. Okay, but what's not explained is what they had to do to get there, the work that was put in to get there, the amount of research they put in to get there, and the losses building up to get there. So casino players make big wins, but you can make big losses just the same. I've seen people make $75,000 in 1 hour, lose 45 in the next hour. I don't mind because they still won 30, they had 30,000 when they left. Just like when you go to the casino. Go to the casino, you win big, and you'll continue trying to play to make even more money versus walking away. Now, is that a bad thing? No. I like my casino players, but I have a foundation that's built such that even if I don't make a lot of money with my casino players, I have something backing me. Or if I have a loss, I have something backing me. And that's my strategy. And then there's creative trends, which are new ways of investing that most people have never heard of, or something that's trending, that's new, that you can put a lot of money into if you choose to. Now, do you have to do all of these? Absolutely not. Pick and choose what works for you. You know what you can handle. And so with this series, we're going to have several small videos, hopefully. I get talkative, you guys know that, where we're going to cover each one of those. And we're going to start today by building the foundation and talking about our foundation builders. So the two things that we're currently using as foundation builders are income stocks and our BlockFi account. Foundation builders, as I mentioned, are things that you can invest in that are pretty solid. They're not going to break the bank and give you $100,000 in 30 days, but they will build consistently via compounding. Y'all know that's my favorite word, compounding effect that will continue to bring in more income. So with income stocks, I like to find stocks that are particularly lower in cost because I can buy a lot more of them. I like stocks that are $20 or less. I like stocks that pay out monthly and quarterly. And in building my income portfolio, that produces income every month consistently. I know exactly how much I'm going to get. I know exactly what date I'm going to get it, just like a paycheck at a job where you're receiving a W-2. Now, here's the pros and cons of your foundation builders. Foundation builders normally take a lot of money to see a lot of money up front. Or you can start building slowly. Don't worry about the fact that, oh, all I got is $1, but you only put in $20. Build it. If all you have is $20 a month to start building, then start there. If you can put in $1,000, start there. The purpose of a foundation builder is that you're building something that you can then go and do something else while this is building in the background for you. The more employees, i.e. money, you can put into your foundation builders, the faster it's going to grow. Provided here are some of the income stocks that we've posted before, but these are the main ones that I have in my personal foundation builder account. Now, my income stocks, I put in a separate broker. I put it in the IRA in my Ally Invest account. And the reason why I did that is, one, for tax purposes. The strategy here is that I'm going to continue to build my income stocks, let them continue to work for me. I don't intend to pull money out from this. The idea is to let it continue working for me until I retire. That way, I don't pay tax on any of this right now. I don't want to. I would much rather pay tax on this later when my income is much lower. So my tax bracket will change, thus paying a lower tax. Now, could this backfire me in the end because taxes may change by the time I retire? It could, but for right now, this is the vision and the strategy that I have for this. So every month, I am putting some money into my Ally Invest account. Some of that money comes from the money that I've earned or gained from my casino plays, where I've earned $3,000, $4,000, $5,000, and I took some of that and put it in my IRA account and bought some income stocks. It's called a self-managed IRA account. So with these, most of these are under $20. Some of them are not. Most of these pay monthly. AT&T, which is the T ticker symbol, pays quarterly, but I like them because there's potential for the actual price of the stock to go up and the dividends that I receive from them. So I like AT&T for that purpose. Most of these we've already done videos on. There's posts throughout the Patreon account about these, but these are the ones that I'm building up. And we're going to walk through an example of PSEC and why I like it and how it works, and how you can go through each one of these to decide which stocks you want to use. Now, are these the only ones you can get? No, there's plenty of dividend paying stocks. For example, Coca-Cola, ticker symbol KO, it pays quarterly. The stock price is about $45. And you'll receive about 45, maybe 50 cents per share. Johnson & Johnson pays, but Johnson & Johnson is about $150, maybe $170 a share. So to receive $1, I can buy 4, 5, 6, 7, maybe 10 shares of something else and be able to get a little bit more on the growth end of it and from the dividends. So you have to kind of play around from a math perspective to identify what will give you the most in the end. The purpose of income stocks is to create income, passive income, not so much growth as far as the price of the stock. You'll hear me say it time and time again. With dividend stocks, the price of the stock isn't your business. How much income they're producing is your business. So when the stock price goes up and down, I don't care. As long as they're giving me dividends and they're still in business, I am good with it. A company that is about to go out of business, they're not in position to pay, they're not going to be paying dividends. They're going to stop paying dividends before the company goes out of business. That is a sign that something isn't right. If all of a sudden Coca-Cola stopped paying dividends, I need to know one of two things. Are you quitting paying dividends after paying out dividends for over 50 years because you're focused on growth of the company, and instead of paying out to investors, you're paying out for research and development and to grow the stock price? Okay, I might stick with you. But if you don't have a why, then I'm probably going to get rid of you. You don't see that too often where a company stops paying dividends when it's a good company. So that's why this belongs in the foundation builders, because it builds itself up. You send the employees out and you go find your next investment. The second one I like for foundation builders, you know, guys know I love BlockFi and cryptocurrency. We have plenty of videos showing how that works. So just go back in history and you'll be able to see how to set up your BlockFi and how it works. Plus, you'll see the monthly post showing what my current growth is from an account started from scratch. So let's take a look at how dividends work. So using PSEC, PSEC is $8 a share. Things you need to know: one is ex-dividend date. Ex-dividend date is the date that the company will look to see how many shares you own. That is the number they're going to go by and send your check for, not how many shares you have after that date. It's before that date. So the ex-dividend date for PSEC is at this current time, April 29th. That's this month. So however many shares I have, I say on April 28th is the date I go by. I always go by the date before. So let's say I have 2,000 shares of this on April 28th. And let's say the payout date is May 15th. On May 15th, I'm going to get 2,000 times the dividend that they're offering for the month, which is 6 cents. And that's how much I will get back in my account in cash. Unless you have what's called DRIP turned on, which is a dividend reinvestment program, where the money I would have received in cash in my account would instead buy more shares, however many shares it could buy. I like DRIPs because it helps you to build faster, more and more shares. So ex-dividend date is important to see and to know. Dividend yield, so when you see that, I like dividend yield for my income stocks to be over 7%. And what that means is that based on the price of the stock and how much dividends you're receiving, so you take your dividends, your total dividends, usually the annual dividend, and divide it by the current price of the stock, and that gives you your dividend yield. You want a higher yield. That means I'm getting more money per dollar I paid for the stock in the form of a dividend or interest. Be careful. I don't purchase stocks that are 13% or higher. If you're 20% dividend yield, it triggers something for me. I want to know why. Because there are companies that may give more to their stockholders to try to hold on to them versus fixing the problems of the business. Usually that happens with small companies. You're not going to see that type of thing happen with your Coca-Colas or your Johnson & Johnsons or your small companies. If a company is taking all of their profit and giving it out, what money are they using to grow or to maintain or to have reserve money in case something happens? So that's just looking at all perspectives of how to operate a business. And a high yield is not business savvy. 25, 30% dividend yield, that's not business savvy, because you don't have money for something at that point, unless it is a REIT or a type of vehicle that requires the company to pay out most of its net profits to its investment holders. That's different. All right. So you normally will see either the annual dividend or the monthly dividend. For PSEC, it pays out a total of 72 cents per share that you own annually. It pays out monthly. So every month, it has been consistent at giving 6 cents per share. So if I own let's say I own 100 shares, as an example. At 100 shares, I'm going to get $6 a month. If I have 1,000 shares, I'm going to get $60 per month. But as I mentioned, there's this thing called a DRIP, DRIP, Dividend Reinvestment Program. Contact your broker to identify how to turn that on. Most of them have it, and it's normally just a flip of a switch. And what it will do is reinvest back into the company that gave you the dividends, more shares. So let's say if I had 1,000 shares and I'm getting $60 per month. If I turn on a DRIP, that $60 instead will give me 8 more shares. So the next month that comes around, instead of 1,000 shares, it's 1,008 shares. So then it's going to buy me a total of however much that calculates to be of shares. So as you see, it compounds, and every month you get more and more and more shares. So if you take a look at the image, this image is not for PSEC, but it kind of gives you a quick glance of how this can passively grow over years for you. from just dividends. You went from having less than $100 a month to over $800 a month by just leaving it in there and letting a drip run. So that's why I said, don't look at the small amount that you start out getting, because compounding along with you buying more and more shares of something will make it grow. And you will look up and go, wow, I didn't know it could grow that fast, because it can. So that's how dividends work. I'll go back to the previous slide so you can see some of the ones I like. I like PSEC. I like Maine because they pay out monthly. They pay about 20 cents per share, plus they have the ability for their stock price to go up. So I like that. And they have a tendency to give 2 additional payouts. So instead of getting 12 payouts, 1 every month, you would end up getting 14 total. Then there's AGNC. There's a ETF called DIV, which has a grouping of high yield dividend stocks that they maintain, and they're consistent about paying out monthly. ORC, OXLC, both monthly. AT&T plays quarterly, and so does CSWC. Now, one last thing before we end this is that some people ask, well, why get quarterly payouts versus monthly? Most companies pay out quarterly dividends. That is the normal. It is not normal to find monthlies. If you do the math, in some cases, you can make more with companies that pay out quarterly because you're getting a much larger amount. So let's say if PSEC paid out, it's paying out 6 cents per month, and that's probably going to go up very soon. If it's 6 cents per month, that's 6, 12, 18 cents within 3 months. That's a quarter. Well, what if they said they're paying out 25 cents per quarter? Would it make more sense to get the monthly or the quarterly? 2 things you have to look at. Compounding. Okay, even though it's on paper 6, 12, 18 versus 25. 25 is more, but is it really when compounding comes into play? Because you can make more and more shares within those 3 months. So that's where you have to kind of look at and weigh the both of them. If you choose quarterly stocks, you can still make it to where you get paid out every month, because all companies don't pay out on the same months. They're different months that they pay out. Some start their quarter off in January, others start off in February, and others start off in March. So if that's the case, I can find companies that pay out each of those months and build those out and make that my strategy. There's so many things that you can do once you start playing around with these and seeing their payout dates. One thing I want to make sure that you have access to, and we'll pull this up and then I'll call it an end. So how do you identify, close that out. How do you identify how much a company is paying? I like to go, and if you put in $ and the ticker symbol, in this case, our example is PSEC, and type in dividend history, you'll see the first line, NASDAQ. We like NASDAQ. And you can see the dividend history. Ex-dividend date is 4/29. What is the yield? 9%. Annually, they give a total of 72 cents per share. I like to see consistency. So you can see every month they have been paying out over time. They have not shifted in the cash amount that they've offered. It's been 6 cents per share. And I keep scrolling. It used to be 8 cents back in 2017. But as you can see, they've consistently paid out. And this has been going on for years. It looks like we're going to get to a decade, if not longer. So these are good things that I like about this particular company. And I'm scrolling up here. So things you need to know: ex-dividend date, 4/29. Payout date, 5/20. So with income stocks, you know what you're going to get paid, or rather how much you're going to get paid, and you know when. It's not a guess. It's not a random, I might get a check or I might not get a check. You know exactly what it is. Once you pull up NASDAQ, let's take a look at another one. Let's take a look at AT&T. AT&T pays out quarterly. Total per year is $2.08. They pay out every quarter. The ex-dividend date was April 8th. They're giving out 52 cents per share, and the payout date is May the 3rd. This is every 3 months. As you'll see, they have continually increased the dividend. This is why I love AT&T as an income stock. It's increased over the years. They first started giving out dividends in 2013, 45 cents. It is now 52 cents and will probably continue to grow. I also like them as a growth stock because of the things that they're doing and shifting. So AT&T is a really good one to add. The dividend yield is 6.72%. It works for me. So I do like this one. So if I had 1,000 shares of AT&T, 1,000 times $2.08, that's over $2,000 of income produced. And with DRIP, I could automatically have it reinvest and build for me. So that's it for this part of the strategy. We'll move on to the next one with the next video. If you have any questions, feel free to post at the bottom in the comment section. And I am thinking about building a Google Sheet. You guys know I love Google Sheets based off of these strategies, and it'll be one big Google Sheet. And then you can decide where you want to put everything to keep everything organized.